Global stocks at a new record with AI and renewed hopes of a Middle East deal lifting optimism. And the U.S. and Iran are closing in on an interim agreement to reopen the Strait of Hormuz. Now, President Trump says Iran talks are going well and the waterway will open very soon.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today is Friday the 7th of August. Well, it's been an up and down kind of week, with market sentiment swinging around AI and oil-related developments. There was optimism early on, with President Trump again saying a deal with Iran was close, and you heard a snippet there on that from Francine Lacqua from Bloomberg. Markets once again seem to buy that story, with oil and US bond yields moving lower and with the S&P rebounding to a fresh record high. But as the week progressed, that sentiment has soured somewhat following reports of Houthi attacks, Iran striking targets in the Strait, and with negotiations over the Strait apparently involving Iran and Oman, but not the US. It's hard to imagine the US side being happy with that. Now, this volatility could continue, noting that we have had to put this podcast to bed a little early this week ahead of the US payrolls report, and that one's always capable of delivering a surprise, of course. But this week, I'll be checking in with some of Nomura's global research team. I'll be chatting with Aichi Amamiya in New York to get his take on the coming US CPI and retail sales releases. He'll also be discussing our base case on the Fed and risks around that view. For Europe, Andres Szczepaniak from Nomura's London-based research team will be along. He'll be previewing the policy meeting in Norway, and we'll be chatting about the weather too, perhaps surprisingly, but with European heatwave there having potential implications for activity. And in Japan, we'll check in with Wichiro Nozaki in Tokyo to examine the BOJ outlook, with fresh minutes to be released and following recent FX intervention to support the yen. And finally, I'll cover some key data coming at us across Asia and preview the RBA policy meeting in Australia next Tuesday. Around the world in 20 minutes. Let's dive in. Okay, so let's kick things off in the US, and I'm very fortunate to be joined by Aichi Amamiya, Senior Economist in our New York-based research team. Aichi, thanks for coming back on the podcast.
Hi, Andrew. Thanks for having me.
Okay, so let's start with US CPI. I know that data is coming out next Tuesday, and that's pretty critical for the Fed, of course, and for markets. What are you looking for from that report?
Yeah, so our forecast for a core CPI, which exclude food and energy, is 0.2%, or on rounded basis 0.180%. So road to dense, which is a benign reading. Of course, that is a little bit pickup from the unusually weak reading in June, but still that is the good number from the Fed's perspective. And based on our forecast for PPI and CPI is also scheduled for release next week. Based on our forecast for those two inflation data, our forecast for the core PCE inflation month on month, which is the Fed's preferred metric, is a 0.211% in July. So the month-on-month core PCE inflation for June was at 0.132% or 0.1%, which is a pretty good number.
Okay, nice. And flipping from inflation to growth, I guess another highlight on the calendar next week is the US retail sales report. What could that one tell us about the health of the consumer there?
Yeah. So the consumer data had been pretty strong prior up to June, but we expect some weakness in July. So the consumers, seems to have exhausted some of the support from the tax refunds. And also given the still, elevated inflation and higher gasoline prices, the consumers probably slowed their spending in July. So as a result, our forecast for headline retail sales is negative 0.2% month on month. And excluding volatile components, a control group of retail sales, the likely decline by 0.1% month on month. So both are a little bit weak, compared with the data we have had in the first half of this year.
Okay, good one. Thank you. Look, let's bring this home for the Fed. We've got inflation, we've got growth. What's this mean for the Fed? Can you remind us of your base case and the risks around it?
So, despite some our forecast for the weak retail sales, still the Fed's primary focus is on inflation. So, because the labor markets remain pretty solid and resilient. So, given the CPI forecast for July and beyond July, I think the Fed will likely stay on hold. So no rate hikes indefinitely through the end of 2027, which is the end of our forecast horizon. So, but the risk is, of course, tilted towards some hawkish side. So again, we expect some gradual moderation in year-over-year core PCE inflation going forward. However, there's some upside risk to our inflation outlook. Because of the one major upside risk is the AI investment. So strong AI investment could exert more price pressures on consumer electronics and also some other related products. If you look at the higher semiconductor prices and memory chips, that could feed into the consumer prices. And also another risk is the crude oil prices. Still, traditionally Fed focuses on the core, which exclude energy and food. However, some hawkish FOMC participants are concerned about the series of supply shocks, and then which could feed into the core, right? Because of those upside risks, we are a little bit concerned about, the hawkish surprise at the upcoming FOMC meeting. But our model forecast again is no rate hikes through our end of forecast horizon, which is the end of 2027.
Okay, got it. Good one. H.E., thanks so much. Let's leave it there. Hope you have a great week ahead.
Thank you very much, Andrew.
Now, popping over to Europe, I'm joined by Andres Stepaniak, loyal supporter of our Week Ahead podcast and a key part of our London-based research team. Hey, Andre, how are you?
Hey, Andrew, very good. Thanks. Yourself?
Excellent. Yeah, no, I'm also well. Thank you. Hey, it's been a pretty quiet week so far. I guess we're all watching the Brent oil price, waiting to see if there's any progress in terms of a deal. Calendar looks actually a bit quiet next week too. But I noticed that we do have a Centex survey coming out at the start of next week. That's August data. So could that one be a bit interesting?
I think so, yeah. It's a survey of investor sentiment, and it's very much at the start of the month, so it gives a good gauge to some extent for the surveys that come later on in the month. We would expect to see some improvement in that Centex survey based on the fact that there has been some positivity regarding various Iran war headlines. Likewise, you see in the Euro stocks up over the past couple of days. And so all this sort of feed into some sort of level of positivity in that survey.
Okay, that's interesting. And look, also on the calendar, I guess it's not totally quiet. We have one central bank meeting to look out for. Norges Bank in Norway will be out with a policy announcement. What are you expecting there?
So actually, we're changing our view essentially. So we now think that the Norges Bank will leave rates unchanged at 4.25%. We had previously thought they would raise rates. Essentially, at the Norges Bank's June meeting, their policy rate projections suggested around a 50% chance of a hike in August, and the June minutes said that some members had expressed concern about the stance is not sufficiently restrictive to bring inflation down, and argued in favor of raising the policy rate now at that meeting. Obviously, since then, inflation data has actually surprised the downside for the month of June, and so hence why we now sort of push back our view regarding the next policy move. But certainly it'll be an interesting one and a tight one to watch. If you recall correctly, only a few months back, actually, Norges Bank surprised analysts and markets when they actually raised rates, and so it obviously could be in for a tight one this time around too.
Okay, that's interesting. I guess at 4.25, they already have one of the higher rates in a G10 sense at least. Hey, Andre, final question for you. I've been reading about this one. This is a bit of a curveball. I don't know if you can help me here. Rhine water levels are apparently very low. What's going on?
It's the heat wave. It's essentially this sort of very strong summer we've had so far, and Rhine water levels. We tend to monitor at an area called Kaub, and so Kaub is the shallowest part of the Rhine River, and so it's quite important in Germany actually for transporting production throughout Germany and getting them up to the ports in the north of Germany to then export globally and so forth. And we're actually at record lows for this time of the year. And I think the big concern actually is that with the current heat wave we're sort of seeing in Europe and the expectation of the Rhine water level going lower over the coming weeks, that could really hamper industrial production, and we could see a knock-on impact on GDP growth, and separately could really also impact transport of goods along the Rhine River, and obviously that's causing some concern for businesses.
Hey, that's really interesting. You know, in my part of the world, Australia, I've been watching the impact of cyclones on exports, and I know my colleagues in Asia are very focused on El Nino weather events and potential impacts on food prices. But yeah, I think you've just given us another reminder as we plow through our spreadsheets and keep an eye on the economy. We've got to keep an eye out for Mother Nature as well. Hey, let's leave it there this week, Andre. Thanks for that.
Thanks, Andrew. Great as always.
Now let's move to Japan and get the latest from Wichiro Nozaki from our Tokyo-based research team. Nozaki-san, thanks for joining once more.
Hi, thank you for having me.
Excellent. Now, the BOJ summary of opinions, their minutes are going to be released next Monday the 10th. What could those minutes show? What should we look out for?
Governor Ueda's press conference following the July meeting was quite hawkish. The summary of opinions, which will be next released on next Monday, will likely also include hawkish views from many board members, particularly opinions emphasizing the upside risk to inflation. What I will be watching closely is how specifically the members comment on the timing of the next rate hike. 2 of 9 board members, Takata and Tamura, had already made hawkish comments in June meeting, so the key question will be whether that hawkish stance has broadened further. On the other hand, the discussions at the July meeting should not have reflected the subsequent joint FX intervention by Japan and the US. When considering the September meeting, the political developments after the July meeting are more important. We will need to wait for further communication from the BOJ. Deputy Governor Himino is scheduled to give a speech on August 27th, and Governor Ueda will likely have an opportunity to speak at the G20 meeting at the end of August. In addition, Ueda and Prime Minister Takaichi have been meeting once every 3 months, and late August would be the timing for another meeting. It is still uncertain whether they will meet again, but this is something we should focus on.
Great. Yeah, no, look, this is just so interesting, isn't it? We've got the BOJ, the politics and FX intervention all coming together. We have had confirmation, both from the Japanese and the US side, that there was indeed FX intervention to support the yen. Can you take a step back and tell us what was the MOF trying to achieve here? And I believe there's some data available. Does this show how much has been spent or what could be spent?
The dollar yen had risen to 164 before the intervention, exceeding the levels at which Japan had intervened in the past. I believe the decision to intervene took into account not only market conditions, but also the political timing, including the July BOJ meeting and the government's decision to cut consumption tax and falling approval rate for Takaichi administration. As for the scale of the intervention, the official figure is released at the end of each month, so we will have to wait until the end of August. However, based on data on the BOJ's current account balances, our FX team estimates that the size is about 12 trillion yen. Japan's FX reserves stood at around $1.3 trillion as of the end of June. So a substantial amount appears to remain in highly liquid forms, such as deposit and short-term securities. So I believe it is reasonable to think that Japan still has ample resources available for further interventions.
Okay, excellent. Yeah, those numbers are quite substantial. Good to get those. Thank you. And look, finally, does the yen intervention that we've seen, what implications does that have for the view on the BOJ? Can you quickly outline our view on the policy rate there?
Treasury Secretary Bessent has referred not only to market intervention, but also to the BOJ's monetary policy in discussing how to address yen depreciation. Mimura, the most top official, has also commented on monetary policy. I believe a common understanding has emerged in both Japan and the US that addressing yen weakness should involve monetary policy. As a result, we are now more conscious of the rate hike in the next meeting. However, we continue to see an October rate hike as main scenario. We believe a hike would be easier to justify from fundamentals perspective in October. If the BOJ raises its policy rate in September, the main justification would likely to be the upside risk to inflation, driven particularly by the FX. There is also a risk from the perspective of future policy management that the market could interpret the BOJ as conducting monetary policy with the exchange rate rather than inflation itself.
Got it. So an October hike is the base case, but September clearly the risk as you flagged there. Hey, Nozaki-san, let's end it there. Thanks so much.
Thank you.
And finally, some quick highlights, things we're watching next week from across the broad Asia region. First up, China. We expect CPI inflation there to drop to 0.8% year over year in July from 1% in June, dragged lower by food prices and with less of a boost from energy and core prices. We have core inflation there easing a tenth to 0.9% year over year, driven by weak domestic demand, while we expect PPI inflation for China to remain steady at 4.1% year over year. In China, the monthly credit data will also be released over the coming week, and we have credit growth there as measured by the year-over-year growth in outstanding aggregate financing remaining steady at 7.4%. Now, elsewhere in Asia, deep breath. In India, we expect CPI inflation to moderate to 4.3% year over year in July from 4.4% in June. In Korea, we expect the unemployment rate to remain unchanged at 2.7% in July. And in Singapore and Malaysia, we expect the second readings for Q2 GDP to ease by a tenth in both countries. And then finally, in my part of the world, the Reserve Bank of Australia will be meeting next Tuesday. We remain confident it will announce an unchanged cash rate of 4.35% in what will likely be another unanimous vote. Now, unemployment and underemployment are higher, inflation is lower, and the housing market is weaker than it expected. So that should all support a decision to not tighten policy any further following 3 rate hikes earlier this year. But annual inflation remains well above target and has done so for some years now. Spare capacity is still limited, and a range of data suggests that the economy is not especially weak. We therefore expect the board to reiterate a preparedness to hike again if necessary. Updated staff forecasts should show higher near-term unemployment and lower inflation, and with the forecast likely extended to end 2028, they could show inflation at target throughout that year. But the forecast should also reflect a modestly weaker currency and a lower market path for the cash rate, and both those things should act to push up medium-term growth and inflation projections. Okay, so there you have it, our views on key developments, major market themes, and what to look out for next week. Now, this podcast has been written by Andrew Ticehurst and the Global Markets Research team and edited and produced, as always, by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.